So it is 2 o'clock and happy Friday to everyone. Thank you, panelists, for joining us. And then I see we have several attendees already as well. And so thanks for taking time out of your Friday afternoon to have a brief discussion with us about banking. We've been doing these Rawls Responds webinars since about the beginning of April. And Mike and I have always in our discussions said that you can't talk about real estate without banking and vice versa. And so we've been a little real estate heavy the first couple of weeks. That's primarily because this was originally Dr. Buschbom's idea, and then we ran with it and implemented it on the real estate side as well. And so we're excited to shift the conversation a little bit more to banking today. And so on this slide I'm showing you here, throughout the presentation, we'll use QR codes, meaning that if we mention anything, rather than giving you a web link, you can just take a picture of this code and it will take you to the appropriate place via smartphone. And so here are our previous webinar topics. You can view them on YouTube there with that subscribe link. And we also have posted each of the recordings on our real estate organization website, along with the slides that correspond. And so today our topics is just the current banking environment, and we just intend to kind of have a casual conversation about some very interesting and timely topics in banking. And we're excited to have with us first Chris Furlow from the Texas Bankers Association. So Chris, thanks for being with us. And if you wouldn't mind, just give our audience a little bit of brief background and maybe touch on the Texas Bankers Association as far as what it does as well.
Yeah, you bet. Well, first, I'm very proud to serve at the Texas Bankers Association. We were the first state banking association in the United States, founded in 1885. So there is a very proud tradition of our bankers, and TBA has been a part of growth in Texas since that time. Today, we represent well over 400 banks, which is getting close to about 10% of the FDIC insured institutions in the United States. It's a pretty big number. But the overwhelming majority of our banks are community banks in the state of Texas. And you want to talk about, you go into any town in Texas, and there's going to be the courthouse, and you're going to see a school, and you're going to see some churches, and there's going to be the bank. And those are really the pillars of our communities here in Texas. And that's why I'm personally so proud, because in each of those communities, the banks are inextricably linked to all of those other organizations. If there's a philanthropic thing going on, the bankers are some of the first people that get called to take part. If the church needs somebody to head up the finance committee, you can bet that community banker is going to be the chair of that finance committee. All across the board, if the school needs a fundraiser, all those types of things. And for me, that's the thing I'm most proud of, is that our banks in Texas really are at the heart of every community. I think, we're going to talk about some of those ways that, given the current crisis, we see our bankers even more so as those pivotal players in preserving and keeping the economies going. And, again, it's why I'm so proud. I'm a risk person by background. I came to banking from risk management, had served at the Department of Homeland Security in the days after 9/11. That's what got me into the risk management business. And over the years, had picked up on things like cybersecurity and got pretty deep into that. Had worked with a number of banks and financial institutions and investment firms related to managing risk. And if you really think about it today, for our banks, it's all about risk. I mean, bankers always have been risk managers, mostly from a financial sense. But today, everything that our banks are facing, it's risk much more broadly. We have competitive risk. There are a number of players who want to get into the banking market, and many of them without being regulated like banks, they want to drop in. We do have regulatory risk that banks have been dealing with for a long time. I think most people don't understand that most banks are actually small businesses that support other small businesses. So the regulatory burden really does matter. And in some cases, some competitors in our marketplace aren't held to the same, how should I say, tax standards, Mike Mauldin, that our banks have. And then now we have cyber and digital risk. that is even for our community banks as they do more and more on digital platforms. You have that risk that's ever present, and it's very fast. You can run into a problem from a cybersecurity standpoint just like that, and it can be from an attack from across the globe, even for a community bank in Texas. So my background's on the risk side, and if we can help people to deal with the competitive, the regulatory, and cyber risk environment, then bankers can do what they do best, which is take care of those communities we were talking about at the very beginning.
Well, we're happy to have you on, and I'm glad you mentioned that, because in some of the classes that I've been lecturing in the second half of the semester here, some of the hardest components to conceptualize for students is the idea of risk. And it's been a lot easier over the past couple of weeks because there's been some pretty good examples present, right? And I think we're just happy to have your perspective in this very unusual time. So thanks for taking time out to join us. Also with us today, we've got John Fleming. John, who is a practicing attorney, but I guess for our discussion today, he's relevantly the general counsel of the Texas Mortgage Bankers Association. So John, if you don't mind just introducing yourself to everybody and giving us a little bit about your background.
Certainly, Jared, and thank you for the invitation to be with you today. I have a very deep fondness for anything related to Texas Tech. I spent my childhood in the Texas Panhandle, having gone to elementary school in Pampa, Texas. Have a number of friends who are tech graduates. When my good friend Ann Graham was a professor at the law school out there, I would regularly come out to Lubbock to speak to her law school class on banking law, and you produce some fine students from out there. I've had them as interns, and I'm really excited about what you're doing with your banking school initiative. We think it's a great program, and Tech is just a fine, fine place. I spent 23 years of my legal practice practicing law in Lufkin, Texas, and my practice was centered on commercial real estate and banking and corporate law. In 1999, I got the opportunity to come to the University of Texas Law School, where I spent 3 years in an administrative post and teaching. That was too much like being retired to some extent for me, so I rotated back out. Spent 4 years working as general counsel to a former bank client of mine who was originally from Lubbock and a tech graduate. His name is Danny Payne, and he became the commissioner of the Department of Savings and Mortgage Lending. He asked me to be his general counsel, was there for 4 years before returning to the private sector. I now have the privilege of serving as the general counsel to the Texas Mortgage Bankers Association, together with continuing to represent people in the financial services industry, whether it's a community bank, a large bank with a particular problem interfacing with the regulatory arena, or a non-bank, such as a mortgage banking company or money service business company, or any other number of financial services. And one of the things that I've really learned in the last 5 or 6 years is we talk about banking, but more and more, I think we have to expand the universe and talk about the financial services services industry in general, because so much of what was traditionally banking is now found in a non-bank setting. Look at PayPal and the other kinds of payment system providers that have so dominated what we have. Austin, Texas, for instance, at one point was one of the centers of the country for the technology for prepaid gift cards and reloadable payroll cards. And that is because all of that was driven on an electronic platform, and Austin, as a high-tech center, became the center for the managing of reloadable debit cards and gift cards. So as we look at the universe of banking, I think There now so much competition that is coming from outside of traditional banking, in the payment transfer system and in the non-bank area with respect to mortgage lending, that we've got to look and think more broadly by that. And I think people who are in banking and community banking will have to be concerned about how they upgrade their platforms to be able to continue to compete in a world that's much different than the one I started out in some 35, 40 years ago as a young lawyer. The Texas Mortgage Bankers Association has members who are crossovers with Texas bankers and independent bankers. We have very large national banks who are members. We have regional and community banks who are members. And then we have a lot of non-depository related mortgage companies that are our members, as well as the service providers, such as title insurance companies and mortgage guarantee insurance companies, and software providers who provide all the support that makes the mortgage industry work. And I'm very excited about being with you today because this crisis has shown us why we need to move in a more expeditious manner to electronic platforms because of the issues that we'll talk about later with getting transactions closed when you got to stay at home. And as always, this crisis presents incredible challenges for us in the banking and mortgage banking industry as our customers are unable to make payments and create strains on the entire financial services systems. And we're glad to be here with you today.
Thank you very much. And I think today, the kind of industry depth that we have on our webinar is due primarily to the new Excellence in Banking program at Texas Tech and having Mike on board. And Mike's been on a couple of these, but Mike, if you just want to give a quick kind of overview to anybody out there, who you are and the affiliation here.
Certainly. I'm Mike Mauldin, and I had over 41 years of banking when someone I thought would probably have to examine me, and I moved on into the education field on November 1st of 2019. And I joined Texas Tech and Rawls College of Business. I'll be honest, Jared, first 3 weeks, I was like, what have I done? When the coronavirus hit, I thought, oh my gosh, what have I done? And so all my friends are working 24/7 and just busting. So it feels good to be an educator right now.
Absolutely, absolutely. And last but not least, my colleague on the real estate side at the business school, Dr. Stephen Buschbom, is with us again. Proud to say that he's the father of newborn twins, and that's why he's taking a little break. But thanks for being back with us today, Stephen. Hopefully you can stay awake, long enough.
I'll do my best. Thanks for having me.
Sounds good. Well, we'll go ahead and jump into just an overview of what we're going to talk about today. And these are two articles that there's a lot of information floating around, and we're not even going to go into depth on these two articles, but I thought they will give a good overview for anybody that wants a little background on some of these issues we're talking about. We've done webinars on the PPP program and also mortgage relief, but feel free to use those resources if you want some recommended reading background. And so to our panelists, if you're following financial news or really any news today, bankers have been at the forefront and center of the public discussion. I mean, you can see just some of these headlines here. And I guess the first thing I wanted to ask Chris was, how are bankers doing? I know there's a lot of work being done. How are they managing this kind of new environment that we've been presented with?
Well, I'll tell you, it has not been easy. And as Mike had indicated just in his conversations with his former peers in banking, they have been working 24/7, especially over the last month or so. When the PPP program, the Paycheck Protection Program, was rolled out. It began on Friday, April 3rd. And over that weekend, banks across the state of Texas and across the country really were working nonstop. Over Easter weekend, you had banks that had people in there processing those loans. And what it really boiled down to is that because these community banks are right there, they know they have a relationship with those business owners. And that makes all the difference in the world. You want to talk about why they're committed, why they're literally expending their resources. And by the way, a lot of folks don't recognize that our community banks are putting their liquidity up front on behalf of the federal government. The federal government's supposed to pay them back, and guess what? They haven't been paid a dime yet. But the point is that whether it was committing extra people, having them work overtime over the weekends to get these loans done, they've done it because they know these people. It's like I was saying earlier, they go to church with them. Their kids go to the same school, those types of things. And that is why this program has worked in terms of getting actual money to small businesses this quickly. Could you imagine if the federal government alone was trying to just push out grants the way they traditionally do it? It would have never gotten out that quickly.
Yeah, I mean, the phrase that comes to mind is the importance of relationship banking, right? And we've seen that so much as far as this process has gone in the past couple of weeks.
Yeah, I think the phrase is, it may have come out of the White House, but they've moved more loans in over the last month than it would take 14 years for SBA to do that on their own. I mean, this is tremendous. This would not have happened. Now, this creates some problems, and I'm sure we'll get into this in a bit. It creates problems for the banks because they ask the banks to get the money out and get it out fast. Don't worry about the rules. We'll fix it later. Well, guess what? The banks have done everything that they were asked to do, and they have not been paid. And guess what? The guidance is still coming out. Now, if we want to get into a discussion about ex post facto law, we can do that. But that's the type of those are the things that our community banks are dealing with right now. But they're happy to do it because, again, they're in the communities. They love their communities. It's why they exist. I can't tell you how many bankers say, you know what, this has been the biggest pain in the backside ever, but it's why I'm a community banker, because I know I'm making a difference. And, the thing I point to is Texas led the way in the first round of PPP. We don't have the final numbers on the second round yet, but in the first round, it was over 134,000 PPP loans, totaling over $28 billion.
Wow.
For every one of those, I tell people the numbers are one thing, and we can calculate it and look at it through that lens all day long. But think about that. That's 134,000 businesses. Multiply that by the number of employees each of those businesses have. That's a human impact. That is putting Wes Hoskins, our buddy down at First Community Bank in Corpus Christi, said that's food on the table. And it's true. So yes, they're working very, very hard. They're doing it for a reason. And really our bank employees have been unsung heroes throughout this thing.
Yeah, and I just think in the 15-minute conversation we've had so far, I mean, it's already the point I think has been crystal clear of banks being the underpinnings of the economic restart as we go forward. And I'm looking forward to discussing, kind of the today is the day when Abbott's order expires, and I think we'll get into a little bit of that. But from the mortgage side, John, have you seen the same types of things in the mortgage industry? Is that kind of the environment they've been experiencing?
Yes, Jared, this is a very difficult time for the mortgage industry. We have two totally different things going on. Those of you who are bankers and those of you who are following the markets know that when we hit March, we saw interest rates begin to decline and a significant uptick in new lending for residential lending going on. So the month of March started out as one of the busiest months for mortgage originators, with lots of activity, lots of loans in the pipeline. And then the shutdown orders came in presenting issues of how do we get these loans that are in the pipeline closed? How do we keep up with our borrower status? There are many anecdotal stories of borrowers closing loans on a Friday, getting a disbursement on a loan on Friday, and then calling the lender on Monday asking for a forbearance because they were laid off over the weekend, creating significant issues for the origination and servicing side. Meanwhile, early on in this crisis, the government-sponsored enterprises, Ginnie Mae, Fannie Mae, and Freddie Mac, announced a forbearance program for borrowers, providing that borrowers would be excused for not paying their mortgage payment for at least 6 months and up to a year. And most of you know that at this point, the government-sponsored enterprises, both Ginnie Mae, which does FHA, VA loans, purchases those loans, and Freddie and Fannie, which purchase conventional loans, dominate the mortgage market because most of the loans that are originated right now are sold into the secondary market, probably at least 80%. So one of the things that many people do not realize is that while FHFA, the supervisor for Freddie and Fannie, and HUD as the supervisor for Ginnie Mae and FHA and VA loans, while they provided borrowers for relief, all the servicing agreements provided that the servicer must still pay on a monthly basis all of the principal and interest payments that are due on those loans that are in forbearance on behalf of the borrowers who are not paying. And this created alarms in the mortgage banking circles. While a bank that is servicing loans may have access to some facilities by being able to take their depositors' money to make some of those advances as additional loans, or by relying on access to their ability to access funds through the Federal Reserve, non-mortgage bankers, which represent a great deal of the servicing capacity in this country right now, did not have available to them those back doors. So the government tells borrowers, essentially, you don't have to pay, but is still expecting the servicers to make those payments to the investors, the bondholders, and it's created a significant liquidity issue that has yet to be worked through. This has raised a lot of suspicions as to what's going on. I don't think it's any secret that Mark Calabria, who is the current supervisor and head of the Federal Housing Finance Agency, the supervisor for Fannie and Freddie, probably is of the philosophical position that the Freddie Fannie footprint in the mortgage market should be reduced. And I think there is a lot of sentiment that says that eventually is the right way to go. But the best thing I have heard about what we need to do going forward with Fannie Mae and Freddie Mac came from former Lubbock Congressman Randy Neugebauer. And Congressman Neugebauer at the time was on the House Financial Services Committee and was giving a lot of thought about how to restructure Fannie and Freddie. And he made the following statement. He said that as a conservative Republican, he believed that it was philosophically wrong for these two quasi-public, quasi-private entities, Fannie Mae and Freddie Mac, to have a open-ended line of credit to the United States Treasury. And he believed that that should be scaled back and that there ought to be reforms to make private capital a bigger part of the market. He paused. And then he said, I only ask one thing. Before you shut down Fannie and Freddie, I want somebody to give me at least 6 months notice because I want to sell my house before that happens. In recognition that the footprint was so big that if you did not do the reform of Fannie and Freddie in a very thoughtful, problematic way, you could literally collapse the mortgage industry, and as a result, collapse the housing industry and collapse housing prices across the country. And that is the dilemma that we still face today. And we do think that there is a lot of stress on the non-depository mortgage bankers right now who do perform servicing. They are in desperate need of a true liquidity vehicle in order for them to be able to make those payments to the investors that they are required to under their servicing agreements. One other thing, it must be kept in mind that this is a totally different set of issues than what we faced in 2008 and 2009 when we had the so-called bank bailout. Because in this situation, we do not have a situation where these companies had made bad loans that were not appropriately underwritten, insufficiently vetted, and it collapsed because of bad underwriting. These are loans that would have been fully performing loans, but for the economic disruption caused by the coronavirus and the governmental orders addressed to the coronavirus. So this is not a situation of the financial services industry own making. It truly is something that was beyond their control.
Yeah, that's an interesting point. I've read several articles kind of comparing the two, but I think that's something that we need to keep in mind as to the response to this. And so you guys kind of previewed the two topics I think we wanted to touch on for the majority of our time. But one thing, since today is the day that we start moving back to the reopening of Texas, I just wanted to get your thoughts on kind of what that is going to look like from your industry's perspective. I mean, obviously we've got these federal programs in the background, but I'm talking more about just the resuming normal operations. I thought some of these surveys that I saw prepared by Alexander Babbage were interesting. Essentially, consumers are most looking forward to going to restaurants and shopping in stock stores. But the way that they've operated over the past couple of weeks has been to reduce spending and tap into savings. And so some of that makes sense, some of it doesn't. Just wanted to get your thoughts as we grapple with this, as we hopefully resume normalcy.
Yeah. Well, I think one of the things that we, at least from a banking standpoint, is that we can really appreciate is that the banks have never closed throughout this whole process. And I will tell you that's been a bit of a challenge because as the coronavirus situation, as we went into lockdown, right, you had a number of local officials, for example, when they were wanting to institute local orders, they viewed banks simply as other retail shops. And there wasn't the recognition of the essential role that banks play. And banks are deemed critical infrastructure, essential businesses by the Department of Homeland Security, and their critical infrastructure and security agency. And why? And sometimes we had to express this logic to some local officials and making them understand this by making it very clear. How will your public employee paychecks actually be processed? if the bank people aren't there and on the job? How will all the folks that you're hoping to protect in the community continue to go to the HEB and get the food that they need? How will our senior citizens and their assistance checks get processed, and how will they be able to buy medicine from the local pharmacy? And certainly, how is everybody going to sit there at home and go online and keep a lot of businesses going that way? It's because our bank employees are there, and they have been throughout the whole thing. So, I have to give a shout out to our bank employees. They've really been unsung, because if they weren't there and on the job, nobody else could be doing theirs during this crisis. And that means they've really buoyed our communities. I will say this, one of the things you saw banks do very early on was they may have closed their lobbies, but they didn't close access to banking services. And why did they do that? Well, I'll tell you why. It's because our banks have had to have pandemic plans in place for many years, actually. Again, things that folks did not know. And again, it's another reason why our banks really are underpinning not only the economy, but the communities themselves. And so they closed down their lobbies. They sent folks very effectively through drive-through, or hey, use the ATM or an ITM in terms of getting services. And certainly all of us, when we're doing stuff, we're using these devices and the things that we're on right now. And the banks very effectively did that across the state of Texas, regardless of size. And I think that speaks very well to how the economy of Texas has been able to stay operating. And a large part of it is due to our banks. So now as we move forward, I think it's going to be incumbent upon our banks to kind of look and say, okay, how do we phase back? We phased out. How do we phase back in terms of bringing all of our lobbies open, et cetera, returning our bank operations to full scale? And I think you will see our banks do that in as thoughtful a way as they did coming out, as they did going in, because they asked themselves the right questions and stuff like that. One of the things that we've been working on at TBA is really collecting best practices on behalf of our banks and sharing those so from a peer-to-peer perspective, the banks can be doing that. But we want to be full-on partners with Governor Abbott in the process of reopening Texas. One of the things that we're very proud of is if you look at the group of folks who are advising that the strike force to reopen Texas, there's 7 bankers on there, and it's chaired by Funds, who's a banker. And again, it keeps speaking to that role that banks play. And I can only say this, for those of you, we got a lot of bankers on this webinar, but to those of you who are students and you want a career where you can make a difference in people's lives, again, the things we've been talking about, banking does that. And so I got to give a shout out to our people, because they've just been doing incredible work and really been unsung heroes throughout this.
Mike, we'll mark that and use it as a marketing piece for the EIB, that clip there from Chris.
I definitely want to record that, so I'm going to just cut that out and run it over and over.
Absolutely. And so, John, I'm interested to hear your thoughts, because mortgage banking is a similar discussion, but there's a little bit more of logistics involved, right? Because there's more in-person closings. You had mentioned the notary statute previously. And so what's kind of what you're hearing as far as that process gets reestablished going forward?
Yes, Jared, I would say that the pre-closing part of mortgage origination has continued quite actively during the slowdown. I think one of the things that we continue to see is the interaction up front is done so much over the internet with applications and disclosures, and everything in that pre-approval stage can be, and often is, done through remote means already. So for the mortgage origination side, particularly in the urban centers, this has been more of an issue with the closing process itself, because despite the fact that so much of the application and loan processing aspect of a mortgage loan closing has already moved online. The closing process itself remains significantly a paper and wet ink signature world. One of the problems, for instance, that we have faced on closing the loans that have been approved is the closing of the county courthouses, because you've got to record your real estate documents. And if a county clerk is on limited hours, appointment only hours, or otherwise limiting access, then it becomes very difficult to get your documents recorded. Now, as Jared and I have talked earlier, Texas has been at the forefront of creating a legal infrastructure to permit the closing of real estate transactions from an electronic platform. For instance, Texas was an early adopter of the Uniform Real Property Electronic Recording Act, which provided that mortgages and other documents relating to the transfer of an interest in real estate can be submitted to the county clerk's offices and recorded by electronic means. When we looked at this in 2019 in the legislative session, we discovered that only 63 counties out of 254 counties in Texas had adopted the capacity for electronic recording. And while that system works well in regular times, in the counties where you could not electronically record your documents as a result of limited hours and accessibility to the county clerk's offices, it became very difficult to get these loans closed. Now, while only 63 counties in Texas have the capacity for recording electronic documents, leaving 180 counties without that accessibility, 85% of the Texas population lives in one of the 63 counties where the electronic recording is available. So this is primarily an issue that exists outside of the heavily populated urban areas, because all of those counties are able to record electronically. One of the other challenges that's been presented, even in counties that record electronically, is that the title companies are reluctant to issue title insurance policies, even in counties that record electronically, because those counties and many counties across the state have been unable to sufficiently staff their offices to update all the indexes of the real estate records. So if you close a loan today electronically and you record that document this afternoon, it may take until Monday or Tuesday of next week before the county clerk can certify to the title company that there were no other intervening documents filed with respect to that particular piece of real estate from the time the title commitment was issued this week through the time of the recording of the documents, even if done electronically, on Friday afternoon at 3:30. So these are some of the challenges that we are having.
Well, I hadn't even thought of that title insurance issue. That's
Yeah.
it just makes you see the true trickle down effect of these closings, et cetera. And so the first, I think probably the most talked about kind of banking issue, there's been a lot, but the most talked about has been the Paycheck Protection Program. And we did a previous webinar kind of on the basics of the PPP, but I just wanted to get you guys kind of thoughts on how it's gone, how this relationship with the Treasury issuing regulations, but the program being administered by the SBA, and just some of these implementation issues. Not that I want to sit here and harp on the PPP, because we all kind of know what it is, but just hearing from you guys how it's going, I think will be interesting for us all to hear. So Chris, you want to lead us off there?
Oh, and I had one other issue I wanted
sure.
to bring up just to kind of sprinkle into the conversation. Wanted to also get your thoughts on the PPP loans serving as collateral for the Federal Home Loan Bank. So in other words, small community banks, local banks can post their PPP loans as collateral to the FHLB, and how that maybe will help liquidity concerns, since I think it was mentioned early on about not seeing a dime from the federal government yet.
Yeah. Well, let's be honest about it from the get-go. If you've spent any time in Washington thinking that the Small Business Administration, with its typical limited budget, was all of a sudden going to be able to manage a program that was going to push through close to $350 billion in the first round, and not expect some problems. I think everybody expected that. I've likened it as to trying to drive a Mack truck through an oil funnel. That's essentially what folks have been trying to do through this program. So the fact that we saw Treasury come in to provide some oversight, I think is not a surprise. And in fact, as far as the breaking news, just over the last 24 hours, you may have seen that Secretary Mnuchin in Treasury has sent his deputy, the number 2, the deputy secretary, over to SBA as they continue to administer that program. I think that tells you a couple things. One is they need the help over there from a leadership perspective, and number 2, I think it tells us that what a critically important program this is. It has not been easy. I think from the very get-go, one of the biggest challenges has been on the technology side. A lot of community bankers who've been.
I can feel with that for sure.
Yeah. A lot of community bankers who've been affiliated with the SBA 7A program for many years. A lot of them kind of got out of it. Not everybody, but they did because it was just a bit of a hassle. And certainly earlier today we were on the phone with Patrick McHenry, who is the ranking member on the House Financial Services Committee, and he likened the technology SBA is using to a 1964 Volkswagen Beetle. And yet we're trying to leverage that here well into the 21st century as a mechanism for getting this much funding out to our small businesses. So it has not been without its problems. And then the other piece that's been very difficult has been on the guidance side. So you may recall probably in the last week of March or so, what the word that had come out of Washington was, hey, don't worry, we're going to have all this money for small businesses, we're going to protect jobs, and hey, banks, we're going to use you guys to do it. Don't worry about it, we're going to streamline it. Everything's going to be streamlined. Go make the loans and we'll take care of everything later. And I think Washington is certainly learning, unfortunately, that it's just not that easy. Particularly in such a highly regulated industry. And that's one of the concerns that our bankers have. Now, to our bankers' credit, and this is really, really important to make, and certainly as we advocate on behalf of our bankers are patriots. They did it, and they did it in record time. A massive amount of money that has gotten out to our small businesses. Again, just off of the numbers that we gave out earlier, we're talking about hundreds of thousands of jobs here in Texas alone. $28 billion. We're now well over that, by the way. When the numbers get updated, we'll probably be pushing between 40 and 50 billion just here in Texas. And so the massive program that this has been, our bankers basically overcame those obstacles. A lot of it came through them working through the technology issues, just being persistent. I have to tell you, over the last couple of days, particularly on Monday, when they restarted the program, it was very difficult for many of our community banks to get onto that system. They would get 3 or 4 screens into the process to load a loan and it would kick them out. So you have to imagine how perseverant you have to be and how
Yes.
badly you're trying to help your community. If you're willing to put up with that, put up with that. I'll just leave it at that. So, but they did it. And, finally SBA caught up from a technology standpoint. They loosened some things up as far as what they were doing. They called it pacing, by the way, which basically means that they were admitting that it didn't work without actually apologizing to the people having to use the system.
And in response, was there some time, did I read today that there were times carved out for community banks to access the portal?
Yeah, that was one of the things, and part of this is also how they administered this program. They could have solved a lot of problems on the front end if they'd just been a tad bit more thoughtful and asked bankers across the country. But in essence, there were some concerns because late Sunday, right before this program was going to start again on Monday at 9:30 our time across most of Texas. They talked about allowing institutions that had more than 15,000 loans ready to go to upload by bulk. And you could imagine that if you're a community bank, you're going, well, wait a second, if larger institutions have that opportunity, what's that going to do for us? Are they going to basically take up all the money before we have a shot at it? So what they ended up doing was the first day was just a fiasco from a technology standpoint. At least from the reports that I've got now after a couple of days, everybody was having technology problems. But I think they learned their lesson and said, okay, let's give community banks an opportunity. So on Tuesday, from roughly about 3 o'clock our time to 11 p.m. our time, an 8-hour window, they provided community banks the opportunity exclusively to utilize the system. And there have been technology problems. There have certainly been guidance is going to be really important. And this is the lasting impact here because it will have an impact into the future. We have a certain set of regulators today, and then we have an election that's coming this fall. The regulators after this fall may be different, and their perspective on banks may be different. And
well, and one of the bigger portions of this is the back end, right? The payback regulation and forgiveness program, and that there's tons of unknowns with that, correct?
Forgiveness is huge, right? This is another thing where the government's like, hey, go do this, we'll take care of it later, right? Well, banks are highly regulated. These are loans. The political class love to basically give people the impression that these things were grants. Don't worry, you don't have to pay it back. Well, they are loans, and banks have to, because we're regulated, have to go through that process. Now, if you got people who either were not truthful in their statements about their need on the front end, should the banks be penalized for that? And then certainly when you get to the forgiveness aspect, if a bank has to say, well, guess what? You actually you owe money back, that puts the banks in a very awkward position. Now, again, from an advocacy standpoint, from TBA, our banks have been patriots. They did what was asked, they did it in record time, and they did it without guidance. So we're looking certainly for our federal partners to be able to not only work with us on forgiveness, what the loan looks like, but forgiveness on the process itself, because there were no bumper rails, so to speak. So as you can tell, I get pretty passionate about this thing.
Well, no, you've been living and breathing it for 2 months almost. So
well, I haven't, and that's why I get passionate about it, is because it's our bankers.
Well,
and
yes, as an advocacy group, yes.
They've expended into this program, and the barriers they've had to overcome on behalf of their small businesses and their communities have been incredible. And I think we're still in the moment, so it's not yet appreciated. But I hope when history looks back, that the banking sector will be looked at. In the past, you look at the last crisis, right? It's all the banks were the bad guys, and that thing was what the perception was. Well, in this one, I can tell you the banks have been heroes, and they need to get that credit. And their government, which asked them to do a job, and they did it well and did it quickly, needs to recognize that in terms of how they treat them from a regulatory perspective on this time frame looking forward.
Well
Hey,
said.
Jared,
Yes,
Jared,
sir.
John, and Stephen, I have a question for each of you. You're all real estate experts, and we're running out of time, but through this whole process, the way mortgages are handled in this country is probably as good as anywhere in the world. We've got an outstanding system. Through everything that has happened and much of the conversation in the public and everything going on between the servicer and Fannie and Freddie, have we seen the setback in the mortgage as we've known it, or can we expect to move forward with the mortgage like it has been, and we'll get back on track?
So this is just my kind of personal off the cuff view on that. CMBS coming out of the 2008 subprime fallout reinvented itself a few times. You had CMBS 2.0, 3.0, and basically what we saw was a change in how the loan pools were structured, the documents were structured, and a change in transparency. So if I were to kind of make a, hopefully it's not too far fetched of a projection, I think we'll see maybe some similar things come back to light coming out of this COVID-19 crisis on how the servicer contracts are structured and the obligations, and effectively we'll get creative again for a variety of reasons, liquidity, reprivatizing hopefully Fannie, Freddie, and just kind of recognizing a nice balance in terms of liabilities between borrower, servicer, lender, the entire system.
Jared or John?
Jared, you want to go and then I'll
Go for
weigh
it,
in?
John.
All right. Mike, I think that's an excellent question. I'm going to be optimistic in my answer, but I think it's based on a certain pragmatism along with it. And that is, I do believe that the availability of a long-term fixed rate interest product is fundamental to supporting the housing industry and home ownership. And if you want to look back at the previous recessions, particularly look back to what happened in 2003, 2004, and otherwise, you can find that a large number of the job losses were in the construction industry, which are specifically tied to real estate. So if you do not have commercial mortgage financing, if you do not have residential mortgage financing that is widely accessible and affordable, then you're impacting a significant number of jobs beyond the financial service industry itself. I'm optimistically going to say, yes, we will find a way to do it. And I don't know what that's going to look like, but it's too important. A significant part of our economy is too dependent on real estate for that not to occur.
Mike, I think one thing that's I think transaction costs are going to be exposed here. And John kind of gave an example of it earlier about the breakdown with the courthouse and title insurance, et cetera. And those guys are experts at what they do, but real estate is characterized by really high, long time delay in transaction costs. And there's some exciting technology going on out there, for example, in the oil and gas space with title research, et cetera, that really hasn't been adopted into the bottleneck of the county clerk and their kind of gatekeeping of that system. And it wouldn't surprise me to see some of that technology be pushed further, which would hopefully have a good effect on pricing overall. But I don't know, but that's one prediction I have. So,
if I may speak to that, Jared, I think you're 100% correct. For the last 5 years, the residential mortgage lending community has been looking at ways to move to a truly electronic platform that looks different from what we sometimes think of an electronic transaction. Sometimes when we think of an electronic transaction, we think of being able to go online, print off a PDF form, sign it, send it, fax it back. I'm talking about a true electronic platform where there is no original paper anywhere. And the mortgage industry has been looking at that. The technology is there to do it. During this crisis, we have seen more companies move toward hybrid closing, where the note will be a wet ink signature, but everything else will be signed and transmitted electronically, including the notary. I think that that technology is going to advance. I think companies that have been delayed finding that technology and getting their system set up so they could create electronic vaults for an true electronic note and MERS registry have seen, because of this crisis, that they need to do that. So I've been telling people one of Fleming's fearless forecasts is that by September or October of 2020, the mortgage lending industry will have moved to a point on electronic closings that they would not have otherwise reached until October 2023. I think this advances the ball by a number of years to moving toward a true electronic system, which, Jared, excellent point. It does reduce the transaction cost as a result.
Well, Jared, you know, they often talk about how crisis is the cradle of innovation. And I think that's what John is speaking to right now. There will be innovations that come out of this.
I completely agree. And that's kind of my last question to both of you guys is when we look back on this in 20 years, I mean, what do you hope happens and how we describe this period? Obviously, we wish it wouldn't have happened, but we're in it. And so the response, what's that narrative hopefully going to be?
Well, I will tell you that there will be technological innovations that come out of this. So we talked about the technology problems that we had, for example, with the PPP program. That's going to lead to all kinds of changes. It's going to lead to the way that we do the mortgage lending, as John is saying. But no matter what the crisis is, it always comes back to people and leadership. Because the technology, I don't care in what era, is going to break down. It will fail. It can help, but it can also hurt. And whether it helps or hurts, there are going to be people that are involved. And so from that standpoint, the importance of leadership is crucial. And so as we do get to the end here, I don't want the opportunity to go without thanking you for what y'all are doing at the Rawls College. Because how we deal with the crisis, you know, this is one crisis. As Mike's been through several throughout his career. And, you know, if you have the right people who are focused on fixing the problem and what solutions we need to arrive at to get out of it, I think we're always going to be okay. This too shall pass, and we'll get there. But, you know, to John's point, things like blockchain and other, you know, folks are looking at how do we leverage technology to make things easier for us. That's going to come, and particularly for our next generation of bankers and mortgage bankers, this is going to be a part of their lives. And as we look at the technology, it's going to provide some exciting things. But at the end of the day, we can't replace leadership. So we have to focus on both of those pieces. Interesting take. How about you, John?
Well, Chris, I agree with you 100%. I believe that as we start doing postmortems on the coronavirus crisis, we're going to discover that policymakers and others made huge mistakes. It's just inevitable because a lot of the programs were put together very rapidly. It had to be done that way. I think while we should give a critical eye to the policymakers, I think we also should couple that with a large amount of forgiveness and understanding because they were trying to deal with an immense problem that no one had dealt with before. I hope that coming out of this, that there will be lessons learned and blueprints and templates for how to react for such a mass economic event in the future. One of the reasons I think people are going to be much better off coming out of this crisis is because of things that we learned from the Great Depression. We talk about the Great Recession of 2008. Many of us are old enough to remember the banking crisis and the savings and loan crisis in Texas in the late 80s and early 90s. But coming out of the 1930s is when we first had Fannie Mae created to provide liquidity and to provide an ongoing way to make home lending available when the regular system had frozen up. Coming out of the Great Depression was the creation of the Federal Deposit Insurance Corporation and FDIC insurance, so that amid the massive bank failures in the late 80s, the bank failures of the 2008 banking crisis, not one depositor at the consumer level lost a penny. And that's because of the lessons that were learned. We now have another opportunity to learn new lessons about how to put in place some backstops to deal with crises that we've not dealt with before. And I hope when we look back 20 years from now, we remember the pitfalls, we remember the flaws, but we also remember that there were things put in place that helped us prepare for the next one.
It's a great take. Thank you both. And Mike, as we start to wrap up here, just wanted to toss it over to you for any closing thoughts. And I haven't done a good job of getting you and Stephen involved in this one, but at least wanted to open it up to you here at the end.
Oh, Stephen and I are much better just as eye candy, so we're okay with that. But I think my closing thoughts are, I'm so excited to have both these gentlemen with us. They mean so much to our state, to the industry that they serve, and they're just both outstanding individuals and outstanding in their capacities. So thank you, Chris, and thank you, John.
Absolutely. And Dr. Buschbom, I want to throw anything in there from a real estate perspective, maybe even stuff that we talk about with these guys in the future on a similar program?
Sure. I guess kind of to follow up on the topic of postmortem, I know two things I'll be watching coming out of this crisis that have been of interest to me from, I mean, not just a personal interest standpoint, but research, are companies like Open Door that do iBuying programs, warehousing houses, offering liquidity now for a steeper discount. Mm-hmm. What they look like coming out of this, assume they survive it. That's going to be an interesting topic. And then Airbnb, how that industry stays afloat, because we've had so many technological changes since the last crisis. And I think the common theme going into many of these downturns are basically how far extended or how far over your skis, or, how far out did you put yourself?
Yeah, I saw that headline story on the New York Times the other day about Airbnbs, and so yeah, we're starting to see some of that type of things come to fruition. So I have a feeling we'll have plenty of topics for the next short term at least. So Chris, John, thank you again for your time. Thank you to everybody who joined us.